Are office real estate investment trusts good investments today? Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the fundamentals analyzer software tool. And, as a class, office real estate investment trusts, as a general statement, have been really performing very poorly over the last couple of years. Really since the pandemic and people started working remotely instead of working out of their offices. But that trend is changing. But even with that said, are there any good office real estate investment trusts today, REITs, if you will, that are worth your consideration or your investment dollars? We're going to look at that real closely here in this video, but we're also going to be applying some lessons in valuation as we illustrate and go through the top 10 office real estate investment trusts in the country by market cap. This is a portfolio of the biggest office REITs in America. The highest, the largest is Alexandria Real Estate Equities Inc. with over $17 billion in market cap. Boston Properties is next at $8.66 billion. And then Vornado Realty Trust is down to $4 billion. But I want to talk to you all about some things about these trusts. We're going to use the Fast Graphs Fundamentals Analyzer software tool to illustrate that, first of all, it is a market of stocks and not a stock market. And I also want to illustrate why generalities will often get you in trouble when you're thinking about, investing, because not all stocks are the same, and certainly not all office real estate investment trusts are the same. And valuation can be misleading as well, because the multiples of, in this case, funds from operations, which I'm going to refer to also as earnings of office REITs, in some cases are very, very low, in other cases very, very high, but sometimes even the low valuations do not make these investments good value. So let's start by looking at Equity Commonwealth here. It's a non-rated REIT. It's about $2 billion in market cap. And I want you to note that this REIT, for actually going all the way back to 2003, has seen continuous deterioration in their funds from operations. They fell from $4.88 down to $1.53, $1.18, 92, and as low as 59 cents in 2018. So obviously the price, which is the black line on this graph, has really, performed very poorly. If I do a quick performance check here and look at this REIT going back to January 2nd, 2004, and measure it going all the way out to November 16th of 2023, I would have averaged a 1.8% positive rate of return, but I'd have turned $10,000 into $4,600. I'd have lost 54% roughly of my principal, and that would have given me an annualized loss of 3.81%. Dividends would have almost given me my investment back. So my total, and this is not dividends reinvested, comes out to about $14,600. But I also want you to note something. This company doesn't pay a dividend currently. They paid their last dividend in 2014. So my point is, this particular office REIT has really had very, very poor performance. Now, if I contrast that to, we'll call it Boston Properties, the second largest REIT, we see a totally different picture here. Not all office REITs are the same, and they shouldn't be looked at the same. Now, there are some things that I want you to see as I want you to be able to see what I see when I look at a stock like Boston Properties. Okay, number one, growth has only averaged 2.71%. So growth has been very modest going forward. The dividend yield is currently 7.10%. That's because we're seeing this trading at a blended priced FFO of 7.56, and that gives us a FFO yield of 13.22%. Now, as you know, of those of you who follow my work, I like to see at least 6.5 to 7%, earnings yields, or in this case, FFO yield. And this one almost doubles that. Okay, so, that's really good. The dividend yield is 7%. But I also want you to notice this company hasn't raised their dividend in the last 5 years, actually, or the last 3 years, and expected to not increase their dividend going forward. However, the company does pay some special dividends. So let's go ahead and go into the performance graph. This REIT has actually performed close to, on par with the S&P 500. It's generated significantly more income. A $10,000 investment, going back to the original date here of January 3rd, 2003 to, yesterday, November 16th, 2023, would have thrown off $22,000 in dividends, more than twice your original investment. That's compared to $8,000 in the S&P. However, your $10,000 would have only grown to $14,900, or only grew an annualized rate of 1.94%. But nevertheless, this REIT did give you a 6.49% return compared to 8.77 in the S&P. But again, it definitely underperformed the S&P. All right. Now, I also want you to note that if you look at this particular REIT, they have paid special dividends, like they paid a $2.90 dividend here in 2013. So this company does not have a great record of raising their dividend necessarily, but they do have situations where they've paid special dividends at relatively high rates. So they've generated a lot of income. So, what is this investment about? Now, number one, because of the high yield, I'm assuming, and the fact that it's BBB plus rated, the market has generally applied a rather high valuation. You can see this blue line is a price to FFO of 18.36. And you can see all these times where this REIT traded at a much higher valuation than that. But the point is, there hasn't been a lot of growth here, but there has been a lot of income thrown off, as I illustrated. Now, the office REIT has fallen in value just like all office REITs, but this is a stark contrast to the REIT we just looked at. Now, let's go on and look at some more. Let's go right down the line here now alphabetically. Look at Cousins Properties. As you can see, Cousins Properties is an office REIT that has had very, very dismal performance. They have paid some very high dividends. They've paid some special dividends in the past, but you can see the deterioration in fundamentals on this REIT. And if I even shorten the time frame here, you get a little better picture. There's been virtually no growth in this office REIT at all. Even coming out of COVID, it really didn't seem to have much of an effect on them. Now we have a 6.47% current dividend yield. We have a price to FFO of 7 and a 13%, yield. So that does make it an attractive from a valuation point of view. But this REIT, it's non-rated. They simply don't have any rate. It has modest debt. It has performed rather consistently. But again, it's not what I would call a spectacular investment. The one salient feature here is that you can buy this at a very low valuation. And if it moved back to its normal 12 times FFO, you could be making over 30% annualized over the next couple of years. Okay, so it does look attractive, from a valuation point of view, but it really has never offered very much growth, but entirely different than the other two we looked at. We'll go here and look at Emmett Douglas. Now, Emmett Douglas has a little better record than some of the ones we've just shown, but, FFO is expected to be continued dropping. Once again, coming into the pandemic, we saw FFO drop precipitously. They have been reducing their dividend, apparently, and they've had a pretty inconsistent record of dividends. But what I want to point out is the stock is extremely cheap right now. So again, one of the reasons to consider office REITs would be the fact that they're trading at such a discount to their historical values and certainly what even any idea of intrinsic value would look like. So, as I continue to go through these, I already did Equity Commonwealth. We've had just collapsing fundamentals on it. Highwoods Properties is a pretty good REIT, but virtually no growth. Now, if I shorten that a little bit, I do get 1.69% growth. The market has normally valued this at somewhere around 12 times FFO. It's 12.8 has been the historical. That's the blue line. The orange line has been 11.88, or we'll call it 12 times FFO. And it's currently trading at only a blended price to FFO of 4.96. Now, I want to make a point. We don't have a lot of growth here. We do have a lot of income. Once again, if I look at long-term performance, here I'm going back to 2008. It underperformed the market dramatically by losing actually 2.49% annualized during a period of time when the S&P annualized at 7.58, excluding dividend, 8.52 when you include dividends, and 3.41. But this has been a relatively high-yielding REIT. So I can go into settings here and reinvest dividends just to show you one of the advantages. I had a question on my last thing, why am I recommending reinvesting dividends? I'm not. I'm simply pointing out that if you reinvest dividends, you can generate a little more growth. But that didn't even help. In this case, that did not actually help Highwoods Properties. And the reason for that is because of the current valuation. Now, I want to go and make some other points here before I go on. valuation matters. It matters a lot. You've heard me say that all the time. I don't think measuring performance without simultaneously measuring valuation, first of all, makes any sense. Like I've always said, it's a job half done. But I think more to the point, it's very, very important if you're measuring performance, you need to know how and why that performance was created, okay? Now, looking at Highwood here, I can see, first of all, that it was undervalued based on the orange line being fair value, but it was undervalued during a time of deteriorating valuation. So let's drop that to about 17 years here. Now, it was undervalued with a priced FFO of about 11.48. This was during a time when the market was playing a little higher multiple because we had some consistency and consistent growth. But then, now we've seen this collapse in price, which has been one of the common things of all these office REITs. They've all fallen in value. It's a sector out of favor. And I get that, but that's a general statement. What I want you to focus on is to recognize the fact that even though this industry is out of favor, these companies are vastly different from each other. All office REITs are not the same. Now, this one has a very attractive valuation. It has a dividend yield of 10.64%. You can buy it at under 5 times FFO, which is very, very cheap. It is an investment grade REIT. So this could be, if you're a long-term investor, a very attractive time to be acquiring that. But what I want you to understand is if I look at performance here, and I'll just measure it with the calculator I have here available, this would have only been a 4% rate of return minus 2.17% annualized loss, where it actually fell 27.86% over this time frame. And the only reason we have a positive rate of return because we did get more than our original investment back. It was the original $10,000 investment. We got $10,471 in dividends. And the company has a good dividend record, but again, it hasn't grown the dividend very much, which is something that I like. But the real key here is look how attractively valued this is. All right. Now, I could go through the rest of these, and I'm just going to go through them quickly. You can see JB Smith here has had some deteriorating FFO, and it was very highly valued, and the price has done nothing but drop. It looks entirely different than the other REITs we've looked at. Here's Kilroy Realty Corporation, kind of a very cyclical REIT, does pay some special dividends from time to time. Used to carry a very high premium valuation. The market now has valued it at a very low valuation. And, again, what's causing the lack of performance here, even though it was undervalued here, and it's still undervalued today, you made 5%, okay? But most of that came from your dividend income once again. The point is, I want you to know not only what the performance has been, but how it happened. If I measured performance from this peak here down to this trough, everything's at a loss. You actually lose money because valuation matters and matters a lot. If I measure it from this, very low valuation, even with today's low valuation, you make over 9% a year. So the same company, the same investment, the only thing different here is the value that you're paying to make the investment at the time. So if you were fortunate enough to buy it at this all-time low, even at today's low, the stock still would have generated a relatively acceptable rate of return. And going on here, SL Green, no growth, 1.67%. And so on. Here's Vornado Realty, one of the more popular ones. By the way, very inconsistent, performance from a standpoint of operating history. I think a very poor performance in terms of its dividend record. It has fallen in value, but so has the funds from operations. In other words, the fundamentals here have also fallen in value. Now, this brings me to the feature REIT, and one that I was asked to cover over my last video when I left it out of REITs, and I shouldn't have left this REIT out, but I am going to cover it in this video, and that's Alexandria Real Estate Equities. Now, one of the things about this REIT, and I want to talk about how I go about analyzing REITs like this. First of all, I want you to notice that it has one of the higher growth rates of any of the ones I've showed you, despite having some pretty poor performance during the recession of 08 and 09. COVID didn't have any effect on its performance as far as FFO growth. It was able to grow very nicely through, in fact, at a rate of about 6.47%, right, up to and through COVID. Now, the stock has fallen dramatically in value here recently. In fact, if we draw this as a 14-year graph, kind of post the Great Recession, if you will, I can maybe do 15 years. start seeing 7%. So this is one of the more consistent and one of the faster growing REITs. Now, by the way, because of that, there's always a give and a take when you're looking at investments. This company has more growth than most REITs, but it also has less yield. It's only yielding 4.78%, even at today's very low valuation. Looking at historical yields of this particular REIT, we can see that, 2.5% during these periods of very high valuation, 3%. When the valuation got pretty reasonable, it did get up to 4% like it is today. It's 4.78 today. But the point is, it's not really a high yielding REIT, but it's a good growing REIT. But here's something I want to really use. I want to use this particular time frame. This orange line would represent the intrinsic value. This blue line would represent the value the market applies, which has been much more aggressive than what I would say intrinsic value would indicate. But this stock was trading at a 20 price to FFO here. And so if you bought it then and held it all these years till yesterday's close, you'd have still made 5.6%. Your $10,000 would have grown to $14,000. That's an annualized growth rate, if you will, or growth return of 2.7%. You would have got $6,000 in dividends, so you would have ended up doubling your money, not reinvesting dividends, and that gave you a total return of 102% or 5.63% annually. But here's what I want you to really see. If you'd have waited just a few months and bought this REIT when it was fairly valued at around a 14, we'll call it a 15 multiple, 14.75, even at today's undervaluation and held it to today, you end up making 7.46% rate of return. So the point I want to make is valuation has an impact and a great impact. But the other thing I want to make when I'm looking at this REIT, if I get rid of price and all that, market stuff, this has been a very consistent REIT and a very consistent grower. If I look at performance over this time frame here, which is December 2010 to November 2023, this REIT has grown their dividend by 10%. You would have started out with a 2.56% yield in 2011. Again, this is not a real high yielding REIT, but because of the growth of this particular REIT, they've increased their dividend. Your yield on cost, or what I call growth yield, for last year alone would have been over 9% and rising, and it's been increasing at a rate of approximately 10% per year, average or compound growth rate. So this is a very interesting looking REIT. Now, the other thing is the consistency of it, and a lot of this has to do with what this REIT does. So I'm going to go into external links, I'm going to go into the company's corporate website. And what they've done and what they do is that this company works with technology companies, okay? And as a result, these companies, their workers have stayed at the office. Their office occupancy rates have been much higher than most REITs. That's why we've not seen any deterioration in FFO. Now, the price is down, but the price is down from being massively overvalued, in my opinion, and now it's become undervalued. We're starting to see what looks like it might be a recovery. Just check and see real quickly what it's doing as I do this video right now. It's down just a smidgen today, according to Yahoo Finance. But the point is, this REIT has got very inexpensive, and expectations going forward are for it to continue to grow at about 5%. And, that's been holding steady, pretty steady. They've actually increased the FFO estimates from 897, 898. However, the 24 estimate has fallen from 972 6 months ago to 950 and 996 for 2025 versus 1021 6 months ago. So there is some, idea that this REIT might slow down its growth a little bit, but it's certainly been the most consistent office REIT out here. And it doesn't look like the other office REITs do. So even though it's an office REIT, it's not like all the other office REITs. And that's the main point I'm trying to drive home here. This has been a very consistent producer. Now, what's the future for office REITs look like? Here's an article in the business journals. Outlook for office REITs murky as concerns build around commercial real estate debt market weakness. In other words, there's been some weakness in that debt. But once again, I want to differentiate, Alexandria from a company like Vornado, for example. Alexandria has been a very consistent producer. There's also, I just did a simple Google search here, or I did DuckDuckGo, and I asked workers returning to offices, and like Amazon says, employees may not get promoted if they ignore return to work mandate. Companies mandating employees future of work is a return to the office inevitable. Article by Forbes. Why return to the office at all? CNBC. Return to office policies are getting stricter as work from home fades. So perhaps, just perhaps, the trend is changing, but the trend has not really had an impact on Alexandria. And once again, it's a market of stocks, not a stock market. So if I was going to invest in an office REIT, and at this point I haven't made up my mind to do that, Alexandria would be on my list, but it would be on my list as a total return. If it went back to a 15 PE, I could average almost 23% a year, out to 2025. And that would be, without dividends, about 18.5%, with dividends, about 23%. If I go to the normal multiple, which has been extremely high, I could average 44.68%. Now, let me make sure you're clear about that. The market has consistently put this premium valuation. You see how the stock price hovers around that. It's been, a 20 multiple more than it's been a 15 multiple. And now we can buy it at 11.66 times multiple with almost a 4.75% dividend yield, approaching a 5% dividend yield. This might be a great time to buy that. But the point of this whole story is it's a market of stocks, not a stock market. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, trying to bring you some, insights into this idea of not thinking in generalities, but think in specifics. Like I like to say, mind your owned businesses. Mind your own businesses. In other words, pay attention to the individual stocks you own, because not all stocks are the same. Certainly not all office REITs are the same, as we clearly saw with this video. And I do think Alexandria, which I was asked to cover, so I thought I'd give you this little bonus video this week and go ahead and go through it, because I didn't include it in my last video, and frankly, I should have. Anyway, if you liked the video, give me a like, subscribe to the channel if you haven't, and take a look at subscribing to FastGraphs. We do REITs probably as well as any tool out there, and we also do all the other stocks that are available to you. Investing without FastGraphs, to me, doesn't make any sense, but of course, I'm biased. Thanks for watching.